Welcome back to The Dive. A 50 basis point interest rate hike, the April jobs report, China's zero COVID policy, the aluminum market, oil, gold, and stories that he's following during earnings season. He is the founder of TF Metals Report. Craig Hemke is joining us today. But before we bring you Craig's interview, just do me one quick favor and go ahead and smash that subscribe button so we can continue making you these videos. Hey Craig, welcome back to The Dive.
Oh, hi Cassandra, nice to see you.
Thank you so much for joining us again today. Okay, so let's start with this. The Federal Reserve has implemented a 50 basis point interest rate hike, and Chair Powell said that they want to get rates closer to neutral. Do you think that the central bank can tame inflation to the so-called neutral rate?
They're going to try. Cassandra, you probably heard the term "don't fight the Fed" before,
Yes.
right?
Yes. Mm-hmm.
Let's use that as our theme today, because it was before everything really started getting sideways about 3 weeks ago, about a week before that Bill Dudley, who was the former head of the New York branch of the Federal Reserve. Now, of course, he works for Goldman Sachs, so that's how that generally works. But Bill Dudley was interviewed by Bloomberg or Wall Street Journal or somebody, and he said it's the Fed's goal to inflict more pain, more losses on stock market investors. Now think about that. I mean, I thought the Fed's goal was like control inflation and promote full employment. When did it become their goal to make everybody more poor? But that's what he said. And they're doing a good job of it at this point. And I think we got to believe them, got to take them at their word. They went down this, and I don't know if you remember, we probably talked about this when I wrote my annual forecast back in January, that this year was going to be a lot like 2018 because the Fed is trying to hike rates. They're driving interest rates, they can't control, like mortgage rates and long-term treasury rates, sharply higher. And they're getting them back to the point where they got in 2018, in the fourth quarter of 2018, when the stock market broke. It fell about 10% in October and November of that year. Then it fell another 10% in December. And that was what people now refer to as a Powell pivot. And I think that's where we're heading again. Again, Bill Dudley told you this was coming. The most important thing for people to understand, though, is that the Fed, they're not going, they're playing with fire, first of all. But they're not trying to cut the S&P in half. They've driven through their zero interest rate policies every investor, every foundation, every insurance company, every pension fund, everybody into risk assets. And if they cut the S&P in half, smash the bond market so that you're not making money in stocks or bonds, they're going to do tremendous long-term damage. And so that's where the pivot will come from again. They'll turn again. And when they did in 2018, when they started QE to infinity in March of 2020, that led to huge rallies in the precious metals. And so we're probably on the cusp of that again, but there's probably more pain in the short term first, which is never any fun.
Okay, now job growth rose slightly more than expected to 428,000 in April. While the unemployment rate held at 3.6%. Now, markets seem muted to the report, with stock futures slightly lower and government bond yields mostly rising. What are you seeing in the U.S. labor market?
Well, it's all statistical mumbo jumbo to me. In fact, at my site, TF Metals Report, we've always called it the BLS BS because it comes from the Bureau of Labor Statistics. And it's all just a bunch of statistical guesswork, right? This came out on 6th of May. Sometimes it comes out on whatever the first Friday of the month is. So sometimes it's like the 2nd. So you're telling me that, we know exactly what happened in April by the 6th of the next month? Of course not. So it's all statistical guesswork. And one of the biggest bits of guesswork and fraud, I don't know what you want to call it, is something they call the birth-death adjustment. Now, this was invented back in the Clinton administration, back in the 90s, as a way of massaging the number. And it started out just a couple thousand. So it wasn't really significant, a couple thousand alleged jobs. And what it is, it's not population birthing and dying, it's businesses. And the Fed, in 20 some odd, 40 some odd, whatever years of statistics, knows, and now looking back, how many businesses were born and typically how many businesses die each month. And so they know that. And so they figure, well, okay, if there's this many businesses are being born, that means X number of new jobs. And in April's past, there's this many businesses that go out of business and close up shop. That's a loss of jobs. And so based off of, again, in this course, in this discussion, April's in the past 20 years or whatever, they know on average that there have been more businesses open than have closed. Not that it has anything to do with April 22. They're talking about the last 20 years or 30 years of April's. And so on average, that birth-death adjustment leads to 344,000 new jobs. Now they're just guessing based on what's happened in the past. So of the, what'd you say the number was? 428,000 or something like that?
Yeah.
Okay. Of that 428,000 new jobs, 344,000 came from this guesswork. So from actually calling people up and saying, hey, did you get a new job this month? That's 80,000. Now, if they printed 80,000, what would the bond market reaction have been? All this kind of stuff. Mm-hmm. But they use this statistical guesswork, that nobody ever has to go back and double check or anything like that to make it sound a lot better than it is. And that's what happened last Friday.
Well, that's interesting there. Didn't know that. Okay.
Yeah, it's easily accessible information. Anybody can do Google or whatever and just type in BLS birth death adjustment, and you can pull up the spreadsheet and just show how they do it every single month. Then some months it's not 344,000 every month, and sometimes it's actually negative. But in this case, it's 80% of the alleged jobs, and I don't know, maybe a few of them were there, but I don't know. And in this place and time, did we really have 340,000 new jobs based on businesses starting? I don't know. Have you driven by your local strip mall lately and seen all the vacancies? So anyway.
Okay, so let's move on here. From your view, what's really happening in China and how is it going to affect global markets?
Oh man, isn't it crazy? Haven't we moved past this point of zero COVID? Mm-hmm. Even Australia finally wised up to that, right? It's a virus, for God's sake. It's going to do what it does. But apparently that's what China still wants to, and I don't know. Do you believe them? I really, what do you believe? Not just from China, from any place anymore, but they've so locked down Shanghai that people can't even leave their apartments. And so Shanghai is a major port, industrial center, nothing's moving. And so I guess in a sense, Cassandra, gets back to your very first question. Can the Fed control inflation by raising interest rates? Well, does that impact the supply chain shortages coming out of China by jacking Fed fund 50 basis points? No. Obviously not. So maybe they can impact what they're trying to do is, a reverse wealth effect and demand destruction by working on the demand side of the inflation picture. But the supply side of the inflation picture certainly isn't helping them. And is China doing this on purpose to kind of wield the supply chain as a weapon? I don't know. The U.S. is certainly happy to wield the dollar as a weapon. So maybe they are. It's impossible to say.
Okay. Now, the London Metal Exchange benchmark for aluminum fell to 4-month lows. Some are saying that this is due to ongoing concerns on the demand side created by slowdowns in manufacturing activity in China. How closely are you following the aluminum market?
Well, I've been following all the base metals for quite some time because they've all gone through these spikes and then fallbacks, and then some continue to go higher. It's not just aluminum or zinc or nickel. We've seen iron ore. Remember lumber about a year ago? All these different core industrial metals and supplies have gone through these price spikes. I don't know, it'll be interesting to see whether that means that there's been a drop off in demand or not. But China is, that's one of the key drivers of commodity prices so far this year, but also going further this year, is that what we call their credit impulse, where they're actually loosening policy, where the Fed is tightening policy, and it's having huge impacts on the value of the Chinese yuan. But anyway, they will probably continue to buy things because they're printing as many yuan as they can. And so I don't know, we'll see. Copper's pulled back considerably as well, as has silver and most everything else. We'll see where it goes as we get later into the year, before trying to come to any conclusions on whether that pullback in price in London has anything to do with what's going on in China.
Now, U.S. oil prices rose to around $110 per barrel.
Yeah.
With concerns about global economic growth and the proposed EU sanctions on Russian oil, what is your read on the price action of oil?
Yeah, people got to watch that. That's another thing, Cassandra. I mean, energy's and everything, right? And so it's a key input to inflation. And what does a 50 basis point or 75 basis point rate hike from the Fed do about that? Nothing. And oil looks pretty good on the chart. I mean, as we record this, it's down, but it's certainly holding well above 100. And man, if it starts breaking out and starts challenging those highs from back in March, I mean, it could get crazy. And it's not just the petroleum itself. All of the distillates are just going bananas in terms of and having huge supply shocks. I was driving this weekend, even where I live in central US, diesel fuel is over $5 a gallon. I saw a thing on Twitter that a trucker posted, gassed up his truck, 180 gallons or something, and it was $1,000 freaking dollars.
Oh my.
I mean, how does that not get passed along as higher costs, up the consumer chain, right? But it's not just that. Gasoline is going through the roof because it's all, you start with crude oil, but then you frack it and break it and you bring it down to all these other jet fuel. Jet fuel is through the roof if you tried to book a flight anywhere recently. And so again, these are all these things that the Fed thinks in their academic high ivory tower that they somehow have control over this through policy and through talking. And I think before they ever get control, they're going to be forced to make a choice, either to save the stock market and save the bond market and try to keep the plate spinning, or let inflation keep going. And I think that it'll be proven that they can't control inflation through monetary policy. And so I think in the end, we revert back to buying and QE and all that kind of stuff, because that supply demand picture treasuries isn't changing either. So we'll see. It's going to be continued pain and frustration until we reach that point of the Powell pivot, but we might get there a little quicker than everybody thinks.
According to mining tycoon Frank Justra, the gold price has been manipulated by central bank authorities. One of the common themes amongst precious metal investors that we're hearing is manipulation from the larger institutions. Where do you sit on this debate?
Well, that's why I have a website to begin with. This has been a central tenet of what we do at TF Metals Report for 12 years. Call it manipulation analysis. If you understand that the banks and their trading desks are working against you, then you can kind of figure out, where their positioning is and where price might turn if it gets a little high, and where it might turn if it gets lower. What's fun about Frank coming out and saying that is what kind of drove all of this is he retweeted one of my tweets. And I just pointed out that gold had been absolutely smashed twice in one day. One right after the LBMA open, big washout, high volume, and then right after the COMEX open, big washout, high volume. And so he grabbed that and retweeted it. And I don't know what it's up to, like 3,000 some odd likes or something like that now. But anyway, Frank's no dummy, obviously. Look, the people at GATA have done great work documenting the decades of central bank policy, because the last thing you want is a soaring gold price, as it doesn't reflect well on their policies and their fiat currencies. But today, I think it's more done just as a profit center by these trading banks. Every bullion bank, as they call it, whether it's JP Morgan or Bank of America or Goldman Sachs or Morgan Stanley, they maintain a physical desk in London and a trading desk in New York, and they work hand in hand. Hell, the last set of indictments we had from the U.S. Department of Justice for JP Morgan, they indicted their head of precious metals trading, Michael Nowak, who is not only their head of precious metal trading in New York, he was also on the board of the LBMA. Okay, so the trading desk and the physical desk work kind of hand in glove. And so they know where the orders are for physical that they either don't have and they don't want to get filled. And so they smash price in New York through trading of futures so that spot orders don't get filled. And that's what it just is what it is. It's not like I'm like reinventing the wheel here, sharing anything shocking. I mean, it just is. And so until this system changes, though, this kind of fractional reserve, allocated, unallocated, digital derivative based trading, until that finally breaks down and changes, people like Frank or me are going to continue to be frustrated. But anybody that tries to tell you it's not managed or manipulated either has an agenda they're pushing or they're just dumb and naive, because it just is what it is. And you can use it to your advantage, I guess, if you want. I mean, we're getting close to a low in silver. We'll find a low in silver as soon as the banks, by virtue of the CFTC's own data, are suddenly long again. They're getting very close, and that'll be a sign that silver is ready to turn. You can use this stuff to your advantage once you understand it. And you get a well-recognized billionaire like Frank talking about it. It just helps shine more light on the truth.
So with all the price action in gold, will you still be adding to your position?
Right now, unfortunately, I tried that about a week ago. That hadn't worked real well so far. So at this point, I'm just kind of sitting tight. I'm waiting for more pullback. A little more history, Cassandra. Back in the fourth quarter of 2018, the last time we went through this, where the S&P got flushed, and finally they had a meeting on Christmas Eve of the working group on financial markets, and then suddenly everything turned with the Powell pivot the day after Christmas in 2018. And anybody can Google this. I'm not like making this stuff up. As the S&P broke down through 2,600 support and then plunged 10% down to 2,300, that's when gold finally stabilized and moved higher. It moved higher about 3% while the S&P fell by 10%. But one, it was sniffing out this change of Fed policy that was coming in 19, but also was a safe haven bid. So gold will probably do that too. But on silver, on the other hand, it has tried on multiple occasions now to break down through 22, and it's trying it again right now as we speak. I'm afraid it's going to be successful this time. And it might open up a little trap door down of about 10%, take the mining shares with it. And that'll be my next chance to employ a little dry powder, because we are already so incredibly oversold in silver. And the banks are almost net long again by virtue of the CFTC's commitment of traders report. And we're down 15 days in a row, for God's sake. There's probably a low that's coming. Okay. But until we get there, I think I'm just going to hold off at this point.
Okay. So now that we're well into earnings season, what stories are you following closely?
Well, for the mining shares or in general?
Just in general.
Well, I don't know if even fundamentals matter at this point. This is about herd mentality and everybody being frightened, and the bond market tanking, which is leading to stocks tanking, which leads to kind of a global margin call, where basically hedge funds and speculators just sell anything that has a bid. Anything that has liquidity gets sold, right? The treasury market's been dumping since the first weekend of March, when the US kicked Russia out of SWIFT and froze their offshore foreign currency reserves. I'm afraid we're coming to a point, and I don't think it'll last long. Just like it only took about 2 weeks in December of 18 for the S&P to fall 10% and force that Powell pivot. I think that's coming. And so right now, I don't think fundamentals really matter, whether it's in the mining sector or anything, because if we get into that kind of margin call, liquidity-based event, things just get sold. If it's got a bid, it gets sold. Okay. And that's, again, all part of why the grains are even down. I mean, the fundamentals for corn and soybeans and stuff like that are through the roof, powerful, but yet they're dumping every day. Why? Well, because hedge funds that have been trading corn futures have profits. And when you're getting your rear end kicked and everything else, you sell whatever has a profit. so that you can at least raise some cash and avoid another margin call and a forced liquidation. And that's what we're getting into now. We'll see where it goes. This week's going to be interesting. We got the CPI and some other inflation data. We've got a lot of Fed speakers later this week. I'll be very curious to see where we are by Friday. That's for sure.
Okay, Craig. Well, thank you so much for joining us today. It's always nice to have you on and get your insights. Do you think before you go, you could let our viewers know where they can go to see your blog and more of your commentary?
No, this is what we do. Like I said, it's been 12 years. God, it's been a long 12 years. And we get into these periods like this. It's just no fun for anyone. But if you can make some sense of it all, then at least you can begin to strategize and make a plan. You know, it's like when we went through this, the most recent time was going into COVID, right? And the dollar spiked and everything else went in the tank. And then over the weekend of whatever it was, March the 20th, all of a sudden the Fed announces this alphabet soup of new agency, all these different ways they're going to monetize debt and QE to infinity and drop rates to zero. And then everything goes through the roof. So if you can keep track of all that stuff, then you can kind of be prepared for when those things happen. And that's kind of what we're doing now at TF Metals Report. We're trying to keep track of all this so that we can prepare, because another Powell pivot is coming, and we want to be ready to take advantage of it, because the precious metals and the shares, as lousy as they look right now, are going to look pretty good when all that happens.
All right. Well, thank you, Craig. We'll talk again next month probably, and hopefully you have some better news for us.
Yeah. Hopefully we're all still here, Cassandra. Thanks. It's always good to see you.
Thanks so much for watching today. We'll be back again tomorrow with the silver guru himself, David Morgan. So you're not going to want to miss this. So be sure to hit that notification bell before you leave. Bye.